Hey everyone, it is early Sunday, July 16th. I'm here at the shore. It's an overcast and rainy morning, and we've got another big storm rolling in here in the next little while, but I was up early doing some reading and some thinking, and there's a lot going on and I have some things to say. So we had another strong week in the markets, with the market up 2% across the board. Tech continues to lead things with a really nice run in here, but more importantly, last week the banking system kind of kicked in and on their earnings, and that was good. The bullish tone was set by two economic reports that came in weaker than expected. Employment came in below forecast, signifying the economy is slowing and the Fed should pause on their rate hikes. And then more importantly, CPI, Consumer Price Index, for June year over year came in at 3%. Then that's down in a month from 4%. So a major crash there in CPI. But that being said, it is now forecast with 80% probability that the Fed is set to raise rates at their next meeting coming up soon, 25 basis points. And they talk about, it's this 2% target, this 2% target. Where did they get that? Why did they put a hard line in the sand like that, that if they cross, they have to keep going? There's just no reason for them to do that. It leaves no room for error or adjustment, which is part of investing, part of economies. You don't drive them, you ride them. You don't drive them like rubber on a car on a road where it turns precisely. It's more like surfing on a surfboard or riding a dirt bike. The ground underneath or the waves underneath you slip and slide, and you make body adjustments. You shift your weight. But you don't drive an economy. You don't drive a stock market. You ride it. And this Fed seems to want to drive it into 2%. What's funny is we're at 3%. They talk about this 2% like it's long-term Federal Reserve doctrine, and it's just not. It's about a decade old, that target. The true historical long-term inflation rate for the United States is 2.9%, and we're at 3%. So we're basically right there. The 2% number came in only in 2012, so it's just about a decade old. It was set by Ben Bernanke when we were in a very disinflationary environment coming off of the great financial crisis of 08 and 09. In 09, inflation was negative 0.36. In 2012, when they set the policy, it had gone up, but it was only at 1.7%. But then in 2015, it went back to 0.12. In 2016, it was 1.26. So the Fed was struggling, doing everything they could to push inflation up, at least give us 2%, at least. Otherwise, this Fed is staying to that mantra, but they're trying to push inflation down from 3 to 2%, when 2.9 is really what we've existed with, and 2.9 has been absolutely gangbusters for the economy and the stock market over the last several decades. So why does he continue? Honestly, I don't think Powell has a good ability of learning from his mistakes. He made mistakes by continuing to raise rates despite signs that the economy was slowing in 2017 and 18. In fact, at his last meeting that he rose rates, he actually came in the press conference, said, "We'll be raising rates by 1/4 of a point for as far as I can see into the meetings ahead." And again, like his 2% target, there's just no reason to back yourself into a corner like that. Within weeks, the market had crashed over 20% in a matter of weeks on the heels of that rate hike. And within 6 months, they were cutting rates again. And it was a total, my bad, which he never owned up. The other mistake he didn't learn from is COVID. He left rates way too low for way too long. You put rates at 0 or do quantitative easing when the financial system is gummed up and it can't work. The basic way to tell that is large corporations cannot roll their commercial paper, which is how they make payroll and other expenses while they're waiting for sales revenue to come in. And I've really racked my brain of why do they keep going out of stubbornness. And the only thing I can see is the only pragmatic reason I can see for the Fed continuing to raise rates here at this stage after all they've already done is because they've only got a couple of months left for putting in insurance policies to prevent inflation until we hit the election season in a few months. And you don't want to be doing much rate policy up or down for looking like you're playing favorites in the middle of an election season. So that's the only pragmatic reason. Otherwise, I think it's just stubbornness. Clearly, this Fed Reserve Board is not a market-oriented. I don't think any of them have worked professionally in the markets. I think they're academicians focusing on formulas and theory. Yes, Powell has had some experience in private equity and leveraged finance, but those are deal makers. They're not market people. Unless you've sat on trading desks or managed money in fixed income, do you really understand the lag effects involved in raising or lowering rates? And it's about a year, up to a year lag. I mean, think about it. Even though the economy's doing well, is anyone trying to sell a home? We have a few clients still trying to sell a home, and they're just sitting there and reluctant to lower prices, but they're going to have to. Unless you're in that sweet spot of 400 to 800,000, dollar property values, if you're over $1 million, mortgages are now up at 7%. I mean, they've doubled in the last couple of years, making buying a home, expensive home, twice as expensive. So that's, people are going to continue to have trouble there. But again, our reason for getting good at investing is just because we set policy. When we make mistakes, we quickly correct course and get back on track. It's like sailing. You set a course, you put the sails up based on the current wind, and the wind's going to shift, and you have to adjust your sails. To not do so is, it sets you up for failure or catastrophe. So we do think, though, right now, we are sitting in pretty much I don't want to use the word Goldilocks, but we're in a pretty good spot for the market. It's with the exception of leading indicators and the inverted yield curve, we are in a very good setup for assets and investors here. Let's go through it. You've got a 3% inflation rate. That's great. It's where it's been over many decades. You've got low interest rates, even though they've almost doubled from where they were a year and change ago. But 10 years moved from 1.5%, where you can't make any money on, to 3.6%. You got a 30-year bond at 3.9%. Those are low rates. And before the financial crisis in 07, 10-year was at 6%. In the late 90s, before the tech bubble pop, we were at 6%. So now we're at 3.6. So historically low rates. You can now make 5% plus on your cash. We're buying 1 month, 3 months, 6 month, 9 month, 1 year treasury bills risk-free at 5.4, 5.3%. So that's the first time savers and investors could do that in many years. Corporate balance sheets are in great shape. There's a whole section of the IPO companies that came in 2021 that shouldn't have, who borrowed money in the high yield market. They're in a little bit of trouble, and bankruptcies are going up there, but that's not going to contagion over to the rest of corporate America. Corporate earnings are strong, and the market is trading at 19 times next year's earnings, which is elevated, but it's not frothy. It's not a bubble. 21, 22 times earnings. The market will be up at 5,000 on the S&P if that happens. But these are tolerable. And again, we are in the second half of the year, and that's when the market begins to price in the following year's earnings. For 2024 look pretty good, and 2025 look even better. So I'm happy with how we've navigated the past several years. It's also a valuable lesson. One of my favorite investment books is The Intelligent Investor by Ben Graham. And in there, they talk about maintaining, at all times, somewhere around a 50% stock, 50% bond portfolio, where you're never lower than 25% stocks and 75% bonds, and you're never higher than 75% stocks and 25% bonds. When I read that line many years ago, it changed my entire perspective on market timing, asset allocation, and investing in general. When we got negative on the market heading into 2022, a lot of clients asked, why didn't we just blow out of stocks entirely? Well, because you just don't know how it's going to shape up, right? You don't want to put a hard line in the sand on a judgment call. You want to phase out, but then in 2022, as the weakness showed up, we began to phase in. 2023, we were in this nice position of at equities, but slightly underweight. And then on April 26th, we got back full steam ahead. And, we don't know what's going to happen for the rest of the year because you just never know. But I like the way we're positioned. And these have been some great lessons, and we continue to move on. Think about it, a 50-50 portfolio. You got the bond part is making 5%. The equities are making 15%. That for a retiree, that equals out to a double-digit year, over 10%. And, that's a win as far as we're concerned. So I hope this is helpful. Rain's starting to come down. I'm going to let you go. I hope everyone has a great rest of their Sunday and a great week. Take care.